One of the things that makes real estate the best asset class for regular investors is the incredibly favorable tax treatment that it receives. One of the biggest parts of that tax treatment is the concept of real estate depreciation. In this installment of my Chalkboard Real Estate Investing series, I'll explain what depreciation is and give you a brief overview of how it's calculated and claimed on your taxes. Let's get right into it. Depreciation is a tax deduction that allows property owners to claim a portion of the value of their property as an expense on their tax return. It's an important concept for real estate investors to understand, as it can significantly impact the profitability of an investment. The point of depreciation, and the reason why the government originally allowed it, is to provide a way of recognizing that a property used in business experiences wear and tear over time. It's based on the idea that a property's value decreases as it gets older and needs more maintenance and repairs. This is true in one sense, but also is a bit fictitious in another sense. Yes, as a property gets older, various parts of it must be replaced. Nothing lasts forever. But the depreciation timeframe for real estate is set to just 27.5 years pursuant to the Internal Revenue Code and IRS regulations. But as I'm sure you know, most, if not all, real estate is built to last much longer than that. Hell, many of the properties I own are over 100 years old and they're still standing and continuing to appreciate over time. So in reality, depreciation is not actually occurring in the financial sense. It is more of a legal creation on the part of the federal government to encourage risk-taking and investment in real estate. The idea here is that without tax incentives like depreciation, entrepreneurs will be less likely to want to take on the risk and burden of buying and managing income-producing real estate. Without it, they may very well choose other less management-intensive asset classes to invest in, and in turn, the housing market and the economy would suffer. So the government, to its credit, has so far continued to allow the use of depreciation as a write-off. In order to calculate depreciation, you'll need to determine the property's basis. Basis is the property's cost minus any land value. Once you figure out the basis, you would then divide it by the property's useful life, as determined by the IRS. The resulting amount is the annual depreciation deduction that you can claim on your tax return. As I mentioned, for real property, the useful life is currently deemed to be 27.5 years. So if your property's purchase price was $100,000, you would first subtract the reasonable market value of the land. You'll want to consult with your CPA about exactly how much is reasonable, but in this example, let's say it's $10,000. That leaves a total cost basis of $90,000, which you can depreciate over 27.5 years. $90,000 divided by 27.5 equals approximately $3,272. This is the amount of annual depreciation you can deduct from your real estate income. Other types of non-real property that is used in business can be depreciated as well, and they have shorter useful lives. Claiming depreciation on your taxes allows you to reduce your taxable income by the amount of the deduction. This can have a significant impact on your overall tax liability, especially if you own multiple properties, as it tends to offset a lot of the rental income that you may otherwise have had to pay taxes on. Claiming depreciation on your tax return requires the filing of Form 4562. On it, you will need to provide information about the property, including its basis and useful life. Unless you absolutely love taxes and tax law, I would highly recommend using a tax professional to handle this for you. It's well worth it for the peace of mind of knowing that it was done right and you were able to claim all of the deductions you were entitled to. So that's real estate depreciation in a nutshell. If you have any questions, feel free to drop them in the comments below. Thanks for watching this video. If you got value from it, please leave a like, subscribe, and check out the other videos on my channel where I dive even deeper into various real estate investing topics and concepts.